My name is Rob Berger. Hope you all are having a great Monday. First day of spring, even though I decided to go with the flannel. I guess for the last time, at least until winter. It's a little chilly in Northern Virginia. Hope everyone is doing well. Please give me a thumbs up to let me know you know everything's working. Always get a little nervous that I've hit the wrong button, moved a dial, did something. I don't know. And yeah, you guys noticed 100,000 subscribers. I couldn't have done it without you. Thank you. That was a lot of fun. I was in the 90s, and then I did that video on what happens if a broker fails. You know, YouTube is funny. You know, sometimes I'll do a video and I'm like, this video is brilliant. Well, actually, I don't actually think that too often, but I'll think this is a good video. It's going to do well. I see the thumbs up. Thanks, guys. And it just, it's just like, eh. So I did that video. I'm thinking, I don't know. Seems like a timely topic. And it's got like, I don't know, 600,000 or 700,000 views. And it sort of took me over the top. I thought it would be 2 weeks from tonight when we could talk about the 100K. Although there's really not much to say other than, thank you. And let's keep rolling, I guess. I wanted to take a few minutes to talk about SIPC, the Securities Investor Protection Corp, and FDIC. There were so many questions from that video because it got so many views. It's like 1,000, 1,500 comments. So I haven't read them all. But one thing I said in the video, I said, look, when you have a firm like Fidelity or Vanguard or Schwab, and they've got an ETF or a mutual fund, there's going to be a custodian that sort of holds the assets, and there's accounting involved, and of course audits are done and this sort of thing. But I didn't in the video answer the question, well, what if the custodian bank fails? But see, it's kind of the same situation. There's a fundamental difference between brokerage assets or an ETF mutual fund where the assets are held at a custodian and a bank, right? Because when you deposit money at a bank, at least in a checking account or savings account or CD or whatever, it becomes the bank's money. Now, it creates a liability. They owe you that money back, right? Contractually, it's a liability on their balance sheet, but they mix it in with their assets. They don't keep it separate. They don't say, okay, here's Rob's $25 and we're going to put it over here on the shelf and we're not going to mix it with anything else, right? They don't do that. They said, yep, goes into the pot, and they invest that money, right? They invest it by making car loans, buying securities, home loans, business loans, whatever. Brokerages and custodians in this context, that's not how it works. They keep it separate. It doesn't end up on their balance sheet. It's not their assets. So there's sort of two scenarios, I think, maybe there's more, but two primary scenarios where people might get concerned. One is, bankruptcy. The thing about a bankruptcy, though, is that, let's imagine, it's hard to imagine, but let's just say, I don't know, Fidelity went bankrupt. And the creditors are going to be secured creditors and unsecured creditors. It's part of the bankruptcy estate. And they all come in, and they're, of course, fighting over Fidelity's assets. And then they say, hey, you know what? Let's not stop there. Let's take all of the investments that Fidelity's customers have put into the brokerage account, all the ETFs that they own, all the mutual funds. That's trillions of dollars. Yeah, let's go after that. The bankruptcy court, in my humble opinion, of course, I could be wrong, would say, yeah, slow down there, Speed Racer. That ain't Fidelity's. Those aren't Fidelity's assets. You can't take them. They don't belong to Fidelity. They belong to the customers. And I think the same thing would be the case with a custodian. At least that's my view. I can't think of an argument where it would be, to me, it's a good analogy. By the way, this was not my area of practicing law. So I'm just a guy on YouTube. I'm not a financial advisor. You can listen to me if you want. If you don't want to, that's okay too. But it would be like if a storage facility went bankrupt, and the creditors came in and they took the building and they took all of their computer systems, and they said, wait a minute, I got an idea. Let's take everything in all those storage lockers. Well, sorry, you can't do that. That doesn't belong to the storage company. That belongs to all their customers. Same kind of idea. And in fact, I found this article. This is on Reuters from 2008, when Lehman failed. And this is SIPC, right? Securities Investor Protection Corp. And what they said was, look, we don't have any claims to handle because all the brokerage assets are there. And, again, just because they go under doesn't mean their creditors can get it. All the assets are there. And so all the clients get all their assets. So now, but there's another sort of problem where SIPC can step in. And that's where there's fraud and your assets are gone. So here you think, Bernie Madoff, right? Or you think, I guess FTX, although FTX was in the Bahamas, not in the US. Why anyone in the US would, I don't know what the thinking was. I don't mean to pick on people who lost money, but like, I guess I don't know what the thinking was. I'm going to buy crypto, and rather than buying it at Coinbase, let's say, or some US company, I'm going to go buy it and store it in a company that's decided to be headquartered in the Bahamas. There may have been a reason. I just don't know what it was. But at least allegedly, right? I guess they're still investigating, but there was theft. Now, that was outside the US. But you go back to Bernie Madoff and the money's gone, right? Now, and that's really where the Securities Investor Protection Corp steps in. In fact, let's see if I can find it real quickly. Yeah, here's their website. And I saw a page on here. First of all open cases. There's only one, Bernie Madoff from 2008. That's the only open case they have. But I thought I saw like a history, but I can't find it now. I was surprised at how few there really were. Because again, in the US, brokerage companies have to keep things separate. They're highly regulated. They're audited. So in that sense, it's fundamentally different than FDIC insurance, because in one way that a bank can get in trouble, and really the primary way, is they make bad investments, and they're investing our money that we have at the bank. That's not what a broker is doing. Now, they'll invest your money per your instructions, right? Of course. So if you go tell them to buy shares of Apple, that's what they'll do for you. And there it is. And that might do well or not do well. But they're not taking all your brokerage assets and saying, okay, let's just take all this and decide how we want to invest it. That's effectively what a bank does. So I hope that helps. And I hope it, my view, at least on the custodian. The nice thing about a custodian, so that was the problem with Bernie Madoff, was the custodian, they were all one. So if you think about, let's just imagine a large broker wanted to commit fraud. They're going to have to get the custodian involved, who has control of the assets. And so you're going to have two highly regulated, audited firms, I guess, conspire together to not only steal the assets, but then start producing fraudulent documentation, I suppose, to send out to customers, and fraudulent information on the website when we all log in to see what our accounts look like. And I suppose anything's possible, right? And at some level, you get to a point where, yeah, trust is part of the equation, I suppose. But I think you can see how it would be much, much more difficult when you've divided the responsibility. It's kind of like our federal government. There's sort of checks and balances. So like if you're ever going to work with a financial advisor and they want to take custody of your assets, to me, it's absolutely not. I would never allow it. It would never happen. I mean, because a financial advisor, even if they're going to manage your portfolio, your assets should be, at a broker, not not in some account that they're managing. Obviously, they can, depending on your arrangement, they can buy and sell, but in any event. All right. That's all I had to say about that. I guess I'll look at questions, but that's my view of it. Okay. So I put up the Ask Me Anything kind of thing. That's where you can put your questions. And we've got some. The very first question, how you doing? I guess I'm doing okay. I got no complaints. Although my speed chess game that I played before the show wasn't pretty. I'm going to tell you that right now. Was not pretty. Okay. This is from Devin. What resources do you use to find the articles you share in your newsletter? I enjoy reading them and often find myself wanting more. So I use Feedly. That's just a way to aggregate it aggregates what are called RSS feeds, where I can see very quickly new articles that websites have published. And so I've just over time collected a bunch of websites that I go to. Some of them are themselves collecting and publishing like lists of articles that they found interesting, most of which I find not interesting or not relevant to what we do, what we talk about. So that's basically what I do. So, you know, the one thing you might do is, as you find articles on sites that are interesting, you could add that site to an RSS. You could use, again, I use Feedly. You could use Readwise, I think, has an RSS reader. That's another one. And you could basically just put the URL in. It's very simple. And then you'll see you'll see all of the articles as they get published, lists of them. And you can very quickly, just in that app, I can show you what it looks like. Maybe. Here we go. I'm moving things around. So here's my Feedly. I have a ton of stuff in here, most of which I don't even look at anymore. So this is what it looks like. So like I can, like here's credit.com. This is not one I go to, but I click on this and here are all the articles they've published recently. Here's Kiplinger. They publish a ginormous amount of content. I don't even look at it. New York Times, Think Advice, it goes all the way down. I have a lot of resources, and these are folders. So a lot of these, have a lot of different sites. So I've just collected them over time. I probably have about 15 or so that are high on my list. So if you've subscribed to the newsletter long enough, you see you'll see sites that are I've linked to before because they have good content. All right. I'm kind of switching back and forth here, which is not easy. Let me see if I can clear some things up real quick. I'm going to minimize this. Here it is. Whoops. There we go. Mike says 100,000 subscribers. Woohoo! Thank you. It is kind of exciting, and I guess. No, it is. I get a plaque, I suppose. I don't know. They haven't contacted me. Douglas says, according to the FDIC, 2 banks have failed in 2023. Are more expected. Everyone seems twitchy. Well, yeah, I think more are probably expected. But you have to understand that banks fail all the time. And let me see if I can show you an example. I mean, but they're usually banks that you've never heard of, and they're not big enough to cause a ruckus. See if so like this is probably the list you're referring to. Trying to see if I can't really pull it up any higher, but here are the 2, obviously, Signature Bank and Silicon Valley Bank. And then there are some here that failed in 2020. You probably know. I didn't know. How many? 1, 2, 3, 4 in the 2019. So it's not, and this is, it's not unusual for banks to fail. So I would not at all be surprised if more banks fail in this year. Yeah, it doesn't really make me nervous. Of course, I bank primarily a large bank, but I don't have more than the FDIC coverage. So yeah, Noreen said many people ask what happens to the custodian, and I mentioned it's the same sort of thing. Those assets are not their assets, so I can't personally think of any argument a creditor could make in a bankruptcy to have a claim to our assets that are held in a custodial account. Maybe there's an argument. I've never heard it if there is. Scott wants to know what I think about no penalty CDs for emergency reserves. I think they're great. I've had some in the past. At the moment, I don't. Mine are in Treasury bills. I think I think treasury bills are great. I think no penalty CDs. You could do a CD ladder. I've always felt it was too much trouble, but some people like to do that as part of an emergency fund. You could, if we look at, just even a savings account. Let's see. I'll go to my site. And I think we're doing a good job of covering like the best. I certainly have said to you guys before, and I'll say it again, if you know of better rates, let me know. By the way, here's a no penalty CD for 4.6, but like UFB Direct has got a savings account for 502. Let me just make sure that's still current. They happen to be an advertiser, by the way. I list these from best to worst. Sometimes it's an advertiser up here, sometimes it's not. So I have a code that just spits all this out. There's a lot of them, as you can see. Who's paying 0.01? TD Bank. I don't know. That doesn't seem very promising. Is that their actual? Well, I'll just assume it's accurate. My team does a pretty good job of keeping that up to date. So, I think any of those are good options. The one thing about any CD you have to remember is you put money in and then you take money out. There's no, if you put money into a CD and then a month later you want to put more in, you basically have to open up a new CD. You can't add to an existing CD. And if you take money out, it's all or nothing, which for an emergency fund maybe perfectly fine, right? Maybe perfectly fine, but just keep that in mind. All right. Kakalti wants to know, what does Warren Buffett use to buy securities? MooMoo. In all seriousness, I think it would be fun to be able to look behind the scenes as to how, whether it's Warren Buffett or someone else with lots and lots, companies with lots and lots of money, how they actually manage that. By the way, MooMoo has reached out to me, I'm going to say 100 times. I'm not, 50 to 100 is for sure, to promote them. And I just have not been inclined to do it because I think they focus on the active trader. That's just not what this channel is about. Let me ask a question. I'm gonna do a question here. What I want to know, if you guys are willing to tell me, I gotta create the question here. Bear with me. If I can. Here we go. I'm going to ask a question. Start a poll. Do you use any of these brokers? And I'll put in MooMoo, Robinhood. Who are some of the other? I'll just leave it at those two. And the reason I put those two in, there could be others, but they kind of play towards the active trader, the crypto, the options, at least Robinhood too. And by the way, this isn't judgmental. I'm just curious about my audience. Like, to me, you can use MooMoo in a very responsible way. And I just realized I'm not going to know the numbers of the two. I'm just going to know percentages. Well, that's okay. I'll know total votes, so I can do the math. You can use Robinhood or MooMoo in a way that's consistent with at least what we talk about, right? Buy and hold, long-term investing, but they're not really designed, I don't think, for that. And their business model is not that. They need active traders to make money. So I've Robinhood's never reached out to me, but in MooMoo, I've kind of just said, no, I don't think that makes sense right now. All right. I got to pull the chat back up. I'll leave that going for a minute until I forget about it. And then Noreen says, Rob, did you forget about the poll? And then I'll say, yeah, I sure did. All right. What do we got? Is Bernie still alive? If by that I mean Bernie Madoff, the answer is no. Okay. MF Global, that was another, situation with lost assets for, evil deeds. Okay. Oh, I feel like I've never worked this system before, and I'm very slow, and I'm sorry about that. Okay. Kat said, I just finished The Psychology of Money. It was a great recommendation. What are you reading now? That's a great question. Now, first of all, yeah, cleaned up. So you can't see this, but over here they're just IKEA shelf kind of situation. There's like 6 of them against this wall. And so this desk, in fact, I think by the next live show, will be turned this way, and you'll be looking at the shelves with all of my books so that I look smart. I think that's going to be a better kind of situation for me. Frankly, it's as much to do with just how I want my own office organized as it is what you guys see when I do a video. I have not had a lot of time for reading this month, unfortunately. I've got a lot of books in process. I'm reading Wade Fowles' retirement planning book again, and also his How Much Can You Spend in Retirement book. I'm still reading The Power Broker, which will take me about 5 or 6 years to read. And yeah, that's about it right now, which is kind of sad. But March has been incredibly busy. Hopefully things slow down in April. Okay. Let's see. Ivan says, hey, Rob, great show. Looking forward to reading a novel written by you. And then he wanted to know my opinion on Fundrise. So I'm really at the beginning of the novel, but I wish I could tell you about it. I think I've had all these different ideas banging around in my head, and I think I finally settled on it'll be a series, I think, but the first one. And I'm going to tell you, if I write what at least I'm thinking I'm going to write, it is nothing like what you would probably ever imagine. Yeah. So Fundrise, I've come to the conclusion that I'm just not sort of a real estate syndicate kind of person. Fees, not having control over when it's sold. So I think part of it is just trying to keep things simple. I would just as soon invest in a REIT. But that's not to say that it's a bad investment or that one couldn't make arguments in favor of it. I just don't see the need to add the complexity. There's some liquidity concerns, or concerns might be the wrong word, but restrictions. So I passed on all that. When Lehman failed, were the investors' assets frozen for a time? That's a good question. I don't know the answer to that. I can't imagine they were frozen for long. I don't know why they would be, but I don't know. I don't know the answer to that question. So let's see how we're doing on the poll. So not many of you use MooMoo or Robinhood. Only 17 of you total. And 59% of that 17 use Robinhood. I ended that. Let me, I'm going to ask another question that someone, see, I'm going to say, are you at I'll say regional bank with concerns it might fail? Are you at a regional bank? I guess it doesn't have to be a regional bank. Really, the question is, are you still banking at a bank where you have concerns that it might fail? Yes or no? There we go. All right, that's out there. Go back to the questions. All right. So Dan wants to know, I'm thinking of making a tilt to value this year, 5% of IRA assets, Vanguard fund. What is the risk of small versus large cap? Well, historically, it depends what you mean by risk. Most people think of risk as volatility. And it is true that small cap tends to be more volatile than large cap. And that would be true as far as I know. We can look at some examples, but that would be true whether you're looking at value or growth or a blend. I don't know that that would really matter. Let me see if I can pull up some examples. That's interesting. Is Morningstar's website down? Huh. I can't get to Morningstar. Okay. Well, we'll try something else. Let's do, I guess, Portfolio Visualizer. You know what we can do? We'll just keep it simple. We'll go to the asset allocation and we'll pick, we'll do, since you mentioned value, we'll pick US large cap value and US small cap value. Now, I would expect the standard deviation to be higher for the small cap, meaning it's more volatile. Of course, I could be wrong. And yeah, so I don't know if you can, how well you can see this, but the standard deviation of the large cap is 15%. And the standard deviation of the small cap is 18, we'll call it 18.5%. And that's on a higher compound annual growth rate by 2.5%. So the way to think about that is 2/3 of, if you think of one standard deviation from the mean, it's going to be a wider set of possibilities with the small cap, meaning, yeah, you'll have higher highs and lower lows. So, but the other thing I would say, though, to your question, well, two things. That's historical. I guess the future could be different. But the other thing is that what really matters, I think, for me, is the overall risk of the portfolio. So you can put a risky, meaning volatile asset in a portfolio, but have very little impact on the overall volatility of the portfolio, or even in theory, possibly bring the overall volatility down a little bit, depending on the mix of assets. So yes, I think, in my opinion, small cap's going to be more volatile, therefore more risky as sort of we define risk. I think there are other risks, but it's your portfolio as a whole that really you want to think about in terms of risk. Hope that helps. Okay. Where is all the stuff that is usually behind you? Well, I answered that question, Tom, right? So I'm a little late as I get through this list of questions. I think so. People complained, including family members, that things look messy back there. But I look at it now, and I can look at it in this little monitor that I have. Well, I won't show it to you because I'll probably pull out a cord and everything will go dark. So I can see myself right here. Actually, I can see myself here too. It's very unpleasant. In any event, it just looks so barren back there. And it's like, I've got this art here, if you want to call it that. Of course, you can't see the top of it. Here we go. This is what the whole thing looks like. It doesn't really get any better, does it? When you can see the whole thing, it's like, yeah, what exactly? Is that a bear? What is that? I don't know. It's some painting my father had in the 70s, which is the only reason I still have it, because it's not very pretty. Okay. Anyway, yeah. Next, in 2 weeks, it should be the bookcase with books on it. All right. Ed says, I had rolled over an IRA and decided to wait to invest in something like VTI or BND. And those are two very different things. And instead put it all temporarily into VGSH and SCHO. Oh, and VTIPs, VTIP. What are your thoughts on this strategy? Well, I don't have any thoughts on that strategy. Here's my thoughts. The first is, I think step one is, what are you investing for and what's your time horizon? I'll assume you're investing for retirement and the time horizon is decades from now, but that may not be true. Maybe you're investing to buy a home, right? Or maybe you are investing for retirement, but you plan to retire next year. That matters, right? But once you figure out why you're investing in your time horizon, the next step, I think, is how much do I want to put in stocks and how much do I want to put in bonds? Stocks historically, over long periods of time, perform better than bonds. However, they're more volatile, number one. And number two, bonds can actually outperform stocks over a somewhat lengthy period. Think a decade. It can happen. But that's step two. How much do I want to put in stocks? How much do I want to put in bonds? For me, as a long-term investor, I'm going to want most of it in stocks. When I was many years from retirement, my approach was 90% stocks, 10% bonds. You could certainly make a reasonable argument for a different allocation, but in my view, you want to tilt it towards stocks. As you get closer to retirement, the question becomes, what should your stock bond allocation be? And there are a lot of factors that go into that, including, do you have a pension? What's your Social Security going to be like? How old are you when you retire? How much do you have to spend out of your nest egg each year? Do you plan to buy some form of annuity as part of your retirement? So there's a lot of questions that go into that. For me, someone who's sticking pretty much with funding retirement through the nest egg and eventually Social Security, I generally, as a general rule, want to be somewhere between 50 and 75% stocks. But you've got to figure out the stock bond allocation. And then for me, it's simple, oddly enough. I mean, it's all kind of simple, and I suppose, although it can feel overwhelming. Once you've got that figured out, then you say, okay, well, where do I invest my money that's going to go into stocks, whatever percentage you've decided on, and where do I put my bond money? For stocks, I think a very simple plan would be a total U.S. stock market index fund, like you mentioned. VTI is one example, and I own shares of VTI. I think I own the mutual fund version. And an international fund, I like VXUS, but it's certainly not the only good one. Of course, you've got to decide, well, what percentage in each. You know, I would weight it towards the U.S., but I would still, for me, have some international exposure. You could certainly get more complicated. You could add a REIT. You could add small cap value. We've talked about those things. I don't think that's necessary, but it's also what I did for many, many years, and I still have small cap. And for bonds, I'd still just like a total U.S. bond fund, but there are other ways to like BND, which you mentioned. I don't know why I keep doing this. You can't see this, but that's my computer screen. So, and then you just hold on. You don't change when, you know, the market's down, the stock market's down by 20% and the bond market's down. You know, you ride it out. You deal with your fears and risks outside of the portfolio. How? Not having a lot of debt, having options when it comes to your income. I know those are easy things to say, sitting, you know, in a comfortable chair with nothing behind me, talking into a microphone here. But that to me is the best. That's the best approach. Now, it may not work for you. It may take you some time to get there. I like to deal with the risk, the market risk, outside of my portfolio. And, you know, apart from diversified and all of that, but other people want to deal with the risk inside the portfolio. How? Buying and selling options, you know, investing in inverse funds, active trading in and out to try to sort of figure out where the market's going and prepare for it. And you know, they're doing all of these things inside their portfolio to deal with the fears and the risk. And I've just found, in my view, maybe it's just me, I don't have any confidence that I could do that successfully. By the way, I don't think anyone can, or if there are people that can, they're few and far between. I don't know. Could a Warren Buffett? Probably. But you know, so that's kind of, I should have written all that down. That could be a book. I don't know. That's my overall take on it. All right. Hosea, I guess. What is the difference between FNCMX and QQQ as far as them both being index funds? Why does FNCMX hold 3,384 companies and QQQ only hold 100? Which of these two would be the better long-term? That's a really good question. So let's look at them. FNCMX. Let me look that one up first if Morningstar is working. I can look it up in other places if it's not. They're still down. Is Morningstar down for all of you guys? I'm going to go down here. Can someone tell me if they're able to get to Morningstar? In the meantime, I'll just look it up through finance, I guess. Now I forget the ticker. FNCMX, was that what it was? Hang on. Let me make sure I've got the right ticker. FNCMX, yeah. So FNCMX is the Fidelity NASDAQ Composite Index Fund. Here it is in I don't want that. In Yahoo Finance Holdings. I just want to see so I'm not used to using Yahoo Finance for this anyway. I was looking for the number of holdings. Does it show it here? Let me go back here. Rob Berger should check his DNS. And Morningstar working. Okay. Well, then let me try something else. It could be, I could have tried to access it when it was down for just a split second. Yeah, it's back. And then probably the browser cache is probably what it was. FNM, is it CX? No. There it is. Of course, I could have gone back to Chrome and cleared out the cache, but this is fine. Of course, it's kind of small. Let's make it a little bigger. So if we go to the portfolio, yeah, it's got 33, according to Morningstar, 3337. So, and it's a large cap growth. I mean, so to answer your question, index fund, there are many, many, many different index funds that track different indexes, right? They track US companies, international, small companies, large companies, and so on. So this particular fund is basically tracking the NASDAQ. The QQQ only tracks 100 companies. That's how it's designed. I confess I can't tell you like the thinking behind it. But yeah, they've got 101 according to this equity holdings. One, I don't know what that one might be. The big difference, well, there's a couple of differences, but one of them that's notable is the QQQ has a larger, their average company size is larger. If we go down here to market cap, their average market cap of the companies, the 100 companies, is 342 billion. If we go back to the composite, which is here, the average is 138 billion. So what that means, among other things, in addition to obviously the QQQ tracks larger companies, is that the Fidelity Fund is more diversified. Now, I probably wouldn't pick either fund. That's just because I'm generally not going to invest in a growth fund like that. But that's just my preference. But if I were, I would prefer the broader option, the more diversified option. As to which one, at times QQQ has done phenomenally well, as you probably know. Which one's going to do well over your investing time horizon or mine? Of course, I have no idea. And if someone wanted to own QQQ as part of an overall portfolio and they put 5 or 10% in it, I'd take no issue with that. But it is a fairly, narrowly focused fund. And so that which is, the real big thing here is to understand that difference, which you obviously do. And, what risk you're willing to take. At the end of the day, though, what also matters is your overall portfolio. You're considering one or the other as part of, I presume, some larger portfolio with other investments. And that's what you need to look at. I hope that helps. I don't know. Okay. Jeff says, during a Boglehead 22 session, Mike Piper, who I still need to invite onto the show, he and I already talked about it, noted ceasing auto dividend and interest reinvestment in a taxable account once retired, then using those funds for expenses. Might this go against inflation cushioning? I don't see how. I'm trying to think why that would. I mean, I suppose if you look at stocks long term as maybe a good option to deal with inflation, by spending the dividends, you have left less in stocks. But if you're in retirement, presumably you need to spend the money. I mean, that's the assumption is you have to spend the money to live on. So I don't know what would be your alternative? Reinvest it and then just sell the shares, which to me, if you're going to spend it that year or whatever, it doesn't. I wouldn't reinvest them. I agree with Mike. So maybe I don't understand your question, Jeff, but I don't see it as implicating a question of inflation or dealing with inflation. But maybe I'm just missing something. Noreen, is it cold there, Rob? Looks like you have a flannel shirt on. Yes, it is a little chilly. It's going to get warmer. In fact, I even think I'll be cycling this week. Every now and again, people out in the wild recognize me. Hey, you're the YouTube guy. Doesn't happen too often. But today I was at yoga, and one of the instructors who was not teaching, they were there to take yoga, came up to me. You're in finance, right? YouTube. They saw me because of that Schwab video. I always like that. If you guys see me in the wild, I hope you'll come over and say hello. Okay. Mike Evans wants to know if you've done your end of year S&P 500 prediction yet. No. Well, last year, I think I just picked basically where it was, right? I think. And then it was almost there, but then at the end of the year, I don't know, moved up or down. I don't even know what it is right now. Is it 4,000? Actually, I can just go to my stock app. 39.51. Okay. I'll make a prediction. For those of you that are watching the show for the first time, understand that this prediction is kind of a joke, meaning I have no idea what the S&P 500 will be at the end of the year. More importantly, I'm not making investing decisions based on some view of what it'll be. You guys going to write this down? So 10% would be 400. I'm going to say it's going to be, you don't want to fight the Fed. I don't know what the Fed's going to do. I'll say it's going to be 4,300. There you go. That's my answer. 4,300. Okay. Let's look at this poll. Did we get this? So of 214 votes, 12% said you are at a regional bank with concerns it might fail. One question then is, why are you still there? Of course, the answer might be, one, what you have there is well below the FDIC limits. And the FDIC moves quickly. When a bank fails, they're in and the money's available. And also, it is a pain, like with a checking account anyway, it's a pain to change banks. Okay. Carlos says, if FDIC took over a bank and I have a brokered CD, what do I need to do? Just wait until the CD matures to get my money back? That's a great question. Well, I assume the amounts below the FDIC limits, should be covered. I don't know why it wouldn't, assuming it's, issued by an FDIC member bank. I suspect, Carlos, that's what you would do, but I've never been in that situation. So I'll say this, and this will be helpful, I think, to a lot of people. The FDIC is one of, I think, the few government entities where you can actually call them and they will answer the phone and talk to you. Believe it or not, I was stunned because I called them about Save Better, and they actually got an expert on the phone. I had a nice conversation with them about Save Better. This was months ago. So yeah, call them. But I suspect that's what you would do. Okay. There's a couple questions here that I don't completely follow. I'm sorry. Dave wants to know, what is your guilty pleasure culinary item? None. Is that lame? Like when I want to eat something that This is going to sound really pathetic because I eat pretty healthy. So like for me, a treat will be like a piece of whole grain toast with butter on it. It's true. Now, when we go to the beach, I'll get ice cream. We get pizza, but like when I'm home, which is most of the time, I mean, like today for dinner, well, we did have spaghetti, which is unusual, but even then I had brown rice noodles, and broccoli. Anyway. David, don't worry about the white behind me because, like I said, in 2 weeks, I should be turned a different way. Rob says, hey, did you happen to catch the Bill Maher real-time show on Friday night? Very funny poke at the poor predictive capabilities of the Forbes cover stories over the years. That would be funny. I did not. I will definitely have to check that out. So, I am a Forbes contributor, which means I can write an article for Forbes and literally log in and just publish it. Now they have editors that look at it after it gets published, but I haven't written a Forbes article in forever. Jeff says, do you maintain an online table of contents for the world to source all your videos and blogs? This could save you time answering emails. It's a great idea. And that reminds me, someone emailed me. I don't think I can put my hands on it very quickly. My email has gotten out of hand again, I'm afraid. If I understand what they did, let me see if I can find it. They listened to all my videos and basically took comprehensive notes and then sent it to me. It's like a massive PDF that I haven't even had time to read. Let me just see if I can find it real quick. It's worth looking at. But I'm probably not going to be so lucky. Maybe I'll pull it up for next in 2 weeks. Yeah, I can't find it. It looked really impressive. Maybe I have it open. Let me just see. Nope. Here it is. This is it. Look at this thing. Financial planning notes. Short-term savings rate, asset allocation. This is amazing. Page 1 of 60. Maybe I'll email them back. I'd have to read it, of course, but maybe I'll email them back and see if I'd be happy to make it available, but I need to read it first and then obviously ask the author. But I was impressed. I haven't had time to do anything this month. And the rest of the month's going to get just busier. So Barron wants to know, for the next 20 years, would you dollar cost average into BRKB, VU, or VT? So BRKB is Berkshire Hathaway, VU is the S&P 500, VT is a sort of a world index fund. If I had to pick one of those and couldn't change it, it would probably be VT, but it would be between VT and VU. It wouldn't be Berkshire. I would want more. Berkshire is a very diversified company, but I would want more diversity than one company. Josh wants to know what I think of Merriman's 4-fund combo, which is 25% large cap value, 25% small cap balanced, 25% small cap value, and 25% large cap balanced. So, I've had Paul on the show. He's a good friend. He's done a lot of research into all of this. For me personally, I could not put 50% of my assets, of my stock allocation in small cap. It's just too much. I would not be comfortable with that. I understand what the back testing shows you. We could put it in Portfolio Visualizer. It does show, that it does quite well. Of course, you could just put 100% in small cap value and you do exceedingly well. I'm not convinced that small cap has the advantages that during some historical periods it has had in the past. I'm not convinced of that. It's certainly not to the point of putting 50% of my stock allocation in small cap. So that would not, I would not be comfortable with that. I think I've not had more than probably 10% allocated to small cap. And that's been true for 25 years. So Indy Dave, with current banking risk, should we wait until making more stock market investments? I personally don't think so. We'll be making retirement contributions here as part of our taxes, and I'll put it right to work in whatever allocation I need. So, I mean, of course, obviously what you do, that's up to you, but I just invest when I have it and it makes sense. When I say it makes sense, meaning not that it makes sense because of what the market's doing, but it makes sense because of my cash needs. This time of year, some cash piles up. I mean, not a lot, but some cash piles up because of taxes. Make sure I have money if I owe any taxes, paying the estimated taxes, and then some retirement contributions. So it's kind of sitting there waiting for my tax accountant to get done. And then I'll just put it right in. Frank says, I'm confused about rebalancing during the decumulation phase. I decided on a 70-30 split instead of the bucket strategy. Does it matter if I rebalance before or after I take my yearly distribution? Well, it matters only in the sense that how you rebalance and how you take your distribution will be affected by what order you do it in. So if you take your distribution first, let's put aside taxes, because that's really what's probably going to drive your decisions in terms of which accounts to take from. And if it's a taxable account, then which funds or investments to take from. But let's put taxes aside. If you take the distributions first, it doesn't matter where you take them from if you then rebalance, right? Because you're going to rebalance and you'll be back to your 70-30. If you rebalance first, then when you take the money out, you've got to make sure you take it out in equal proportions or you'll throw your investments out of balance, right? Hope that makes sense. That's the only reason it matters. The other thing I'll add that I found helpful in thinking this through is that you can rebalance. You don't have to rebalance in the accounts you took from. So like you might take from a taxable account, let's say, but when it comes to rebalancing, rebalance inside a retirement account, assuming you have exposure to the relevant asset classes in both. You may take from a taxable account for tax reasons, but rebalance in a retirement account so the rebalancing itself doesn't trigger more taxes. Yeah, hope that makes sense. Douglas says, your videos talk and your book talk about large cap, international, small cap REITs and emerging, but you leave out mid cap. Is there a reason to avoid mid cap? No. The reason I've talked about those 6 is because that's how I invested for a very, very long time. Today, I don't have specific exposure to REITs and emerging markets. I do through total market funds, but I don't have separate REIT or emerging market fund. Not for any reason other than simplicity for me. But those were the asset classes I held for 20 plus years. Now, for the large cap, sometimes what I would do would be have a total U.S. market, which has some mid cap exposure. You could certainly add mid cap fund. It's just another fund to deal with, but you absolutely could. So yeah, I don't think there's any reason to avoid mid cap. What online bank is better, Capital One or Ally? Well, I think they're both good. Capital One has the advantage of having branches, if that's useful to you. I've banked at both, not as my main account, but for online savings. I don't know which one has the better rate. Depends what account you want. You could look that up on my site, allcards.com, or just go to Ally or Capital One, of course. I found them both easy to use. I've probably used Capital One more. The app is very easy to use. Transferring funds between accounts is very easy to do. But when I had an Ally account, it was very easy too. So I liked them both. Rick says, I note that your portfolio includes both VXUS and VFWAX for international. I know one excludes US. Why do you have both? So they both do. I think VFWX excludes, I think, small cap. I think that's right. Well, we can look it up. And then I'll tell you why I have them both. VFWAX. All right, Safari, where did you go? So this one, we can go to portfolio. I'm pretty sure it doesn't have small cap. Weights, yeah, it's no small cap. VXUS does. I would, because VXUS has small cap exposure, that's my preference. The reason I own shares of VFWAX was that back in 2018, lump sum investing, I think I used VXUS. There were losses at the end of 2018, as you may recall. So I did some tax loss harvesting and just converted it over into this fund. More recently, when I've had more money to put into international, I guess for simplicity, I could have just put it back into this fund, but I do prefer VXUS. So that's what I went with. So that's the reason. I don't know if it's a good reason, but that's the reason. All right. Where did my questions go? Noreen, don't forget the poll. I think I've covered the poll, right? There's no more outstanding polls. Why are we so concerned about regional banks? Well, okay, that's a good question. So here's the concern. The FDIC doesn't insure everything, as we know. There's limits. And for most of us, probably on the show here, watching or whatever, I'm guessing most of us, although some might, but most of us probably don't have more than $250,000 in an FDIC insured bank. I don't. But think about a company, they've got payroll, they could easily have millions. And some people have more than 250. And so the concern was that because of the banking scare, people were going to leave regional banks that may not have, maybe in good shape, but not in good as shape as maybe the big banks like Chase and Citibank and Bank of America, Wells Fargo. Also, the thought being that under no set of circumstances would the government ever let those banks fail, because it would just be a total disaster. And so people just feel safer at these bigger banks. And indeed, billions of dollars have poured into those banks over the last week. And so it could hurt the regional banks, and we really need them. They invest into communities. I mean, the big banks do too, but they invest into communities. They provide, frankly, competition, and on a single bank basis, they may not be big compared to obviously like a Chase or Citibank. But you add them up, and it's a significant part of our banking system, and we don't want to lose it. So that would be my quick answer to that question. I think that's basically right. And then Mark wants to know how he would know if his bank is on the verge of failure. Yeah, that's a really difficult thing to know. There are ratios that you can. There's one called the Texas ratio. There's they have different capital ratios. I don't know if the FDIC. Let's see. Does the FDIC? Let me see if they have. I don't think they do. Well, they might. I don't know. FDIC bank ratings. Do they have ratings that they? I don't know that they do. They do have financial reports, but probably nothing like I'm looking at this, but probably nothing that most people are going to want to wade through, myself included, frankly. There are some sites, though. Let me see if I can find them real quick. I know I've talked about them in the past. And now, of course, I can't remember. I looked at them just not that long ago on a I'll tell you where I find it. I did a video on this. Now that I think about it, let me see if I can quickly find it. Yeah. Keep it down. All right. So I did this video. See, there's all my stuff. Doesn't that look better? Anyway, whatever. And so it's how safe is your bank? Here are 4 free tools to find out. And here they are. We'll look at one. So you could say, I'll say, Regions Bank, Birmingham, Alabama. So it gives it a 4-star, you've got to kind of accept it. My recollection is with this site, they don't give you a lot of details, but maybe Weiss Ratings was a little better in terms of details. So search for, probably not going to give us Silicon Valley. No results. That's kind of funny. Signature, they're probably out, right? Signature Bank. That's a different one, I think, because the Signature that failed was in New York. But in any event, we'll just pick Rosemont, Illinois. Signature Bank. They give you data. They don't necessarily give you a lot of behind the scenes on their ratings, but you do see their risk-based capital ratio, and you can click on that and get, I guess it takes you there. These things probably aren't going to mean a lot to you, and frankly, they wouldn't mean a lot to me unless I wanted to really study it. And, I would start, okay, what's a good risk-based capital ratio? What's a good leverage ratio? If you want to accept Weiss Ratings, what they're telling you is all this adds up to an A-. So that might be helpful. I would use this one, I think. And then you could decide whether you wanted to dive into the weeds about what all of these things are, and you could do that if you wanted to. So there you go. I knew I just looked at these. Okay. Rick says, it seems like diversification does not help as much as in the past, and that many investments and sectors move together, including in the last year with stocks and bonds. Any thoughts? Yeah, I think diversification still does work. I think you're right. Over periods of time, things can move together, particularly when they're all driven by the same thing, in this case, rising interest rates. But longer term, I think diversification is still pretty important. I don't think it's the new normal. And by the way, they didn't move in lockstep last year. Stocks were down more than bonds. But you're absolutely right. There are times when they seem to move together. But I don't expect that to be the case long term. That's my view. Okay, when I quit my job, is it as simple as calling Fidelity to roll over my 401 to an IRA? So if you're rolling it over, if your 401k is at Fidelity and you want to roll it over to an IRA at Fidelity, yes, very easy. Call Fidelity. It'll be very simple. If you want to move it from a different administrator to a different, say, broker, it's still not hard, but what I would do is call the company you're going to move it to, Vanguard, Schwab, Fidelity, whatever, because they have teams in place to help you do that. The other thing, I've talked about this, they're actually an advertiser, but Capitalize will help you move your 401k for free. And I've used them and it worked fine. Let me just pull them up for you here. It's Capitalize, it's HI Capitalize, that's the URL, but here it is. So the reason, just so you understand their model, it's free because if you choose to open an IRA at one of the companies where they have a relationship with, like Betterment, for example, Capitalize gets a fee from Betterment. But you don't have to. You can open it up wherever you want, including places where they won't get a fee, and they'll still help you. And if like me, I already had one open, so I didn't even need to open one. They still help me. So you could also talk to them if you wanted to. Noreen says the stream is blurry. Maybe it's not the stream. Maybe I'm blurry. I don't know. Once the stream starts, there's really not a whole lot I can do about it. So hopefully it got better. That comment was a while ago. Brian says, if the U.S. does default on its debt, does that mean we will, I think, lose our money in treasury bills and I-bonds? Well, theoretically speaking, I guess it could, except that it won't. Governments, when you hear about a government defaulting on a bond, which happens, now there could be exceptions. People in chat can point it out, but I got to believe in almost every circumstance, the country has borrowed. The bond is for money, not that country's currency. So it's, Mexico borrowing U.S. dollars, right? Or Russia borrowing euros, right? Because if they've borrowed in their own currency, they can just print more money. So I understand that there's the debt ceiling issue, which is different, but they're not going to default because of that. I mean, who knows how it's going to resolve itself, but it's eventually going to get resolved one way or another. So it's hard for me to imagine a situation where the U.S. defaults on its own bonds that are issued in its own currency. But maybe I'm just not creative enough. Maybe there's a way that can happen. All right. Clownfish wants to know if I hold SCHD in a taxable account or tax deferred. It's tax deferred. Yeah, I don't want to pay the taxes on the dividends. Now, but I do have some dividend paying, investments in a taxable account. You can't really avoid that. And I own banks in a taxable account, but it's a very, relatively speaking, a very small amount. And what I have most of in terms of stocks would be Apple, which its yield is like 0.6 or something, and Berkshire, which doesn't pay any dividend. So Christian says, I'm going to college in a year. Congratulations. I have 15 grand. Where should I invest it for some short-term gains? Bonds, CDs, stocks? Well, if I had 15,000 that I needed in a year, I would put it in an ultra safe, high yield savings account, maybe a CD, maybe treasury bills. That's what I would do. I would not risk it in longer duration bonds or stocks, particularly for something as important as an education. That's what I would do. It's going to earn 5%, let's say. But you're going to spend it in a year. So I wouldn't take any risks with that money. VJ, good to see you, man. Congratulations on 102,000 subscribers. Thank you. And you're one of the ones that helped make that happen. Hope you're doing well. Did you see Ohio State didn't even make the tournament? Did Michigan? I don't even know. I haven't watched. All I know is Purdue got beat. Anyway, it's good to see you, or at least see your name on the screen. Tom wants to know, can you roll a credit union Roth IRA CD into a Fidelity Roth IRA without affecting the annual contribution limits? I believe the answer. So whenever people ask me these questions, I get a little nervous because I'm confident I know the answer, but these things can always get tricky. I think the answer is, of course you can. When you're transferring an IRA from wherever, from one institution to another, that shouldn't count against your contribution limits. At least that's my view. I don't think it does. Now, you can obviously talk to Fidelity. They'll be able to tell you for sure. But I'm confident that it does not count against your contribution limits. But again, remember, I'm just a guy with a YouTube channel. And Dave says, that's way out there. Whole grain toast with butter, living on the edge. So I think I've told you this. I have overnight oats which is oatmeal, rolled oats usually, almond milk, some chia seeds. I think I got that right. I put some blueberries in it in the morning. Sometimes I get wild, throw some honey in there. Usually have a banana. I have a protein shake almost every day. I put BCAA powder in some water once or twice a day. Dinner is usually some sort of basic protein, mainly chicken or fish. I don't eat as much fish as I should. I really like grilled salmon. I need to have that a couple of times a week. Always a grilled vegetable: broccoli, asparagus, zucchini. Usually quinoa. That's sort of my carb, is quinoa. I'll have some eggs. I try to avoid the bacon and sausage kind of thing, but occasionally I will partake. Every now and again, I just, so I'll have a pancake with pure maple syrup. There's nothing better than that. But yeah, it sounds so pathetic as I say it out loud, but I don't know. It works for me. Did you sell or did you keep your bank stocks? That's from VJ again. I've kept them. If I weren't in this period where I'm gearing up for the taxes and all that stuff, I would have probably bought some more. To me, this is like the time to invest. When people get scared and stocks do irrational things, in my view. So like, when Bank of America or whatever is falling 5-6% a day, an investment in it, to me, and by the way, it was trading below book value. I don't know if it still is, although, one could argue if you mark to market their hold to maturity bond portfolio, maybe it's trading at book value. I don't know. You're really just betting that it's not going to fail. And that to me seems like a very reasonable bet. Dawson says, can you comment on VWINX as a conservative bucket in retirement? I've seriously considered placing a very large percentage of the nest egg there when I stop working. VWINX. Let's take a look. Okay. VWINX. What is it? Oh, Wellesley. It's a great fund. It's had a great track record. It's what would we call it? 35, 65 roughly. I think it's a great fund. You've got to get the asset allocation right, the stock bond allocation that you want. But this has had a tremendous track record. It is an actively managed fund, as is Wellington, although it's relatively inexpensive. I think around 35 basis points. No, just 23. But it's done incredibly well. So I can't argue with this fund. I don't own it. But you've got to be comfortable with an actively managed fund. But yeah, it's done extremely well. Dave, please define systematically important financial institution per Dodd-Frank and why that's relevant with regional banks. Well, I don't know that I could define it per Dodd-Frank, at least not off the top of my head. But the issue, the issue with regional banks, and this is why I think some politicians are calling for the FDIC to insure all deposits, is that there's this view that there are some banks that are so important, the Fed will never, ever, the government will never let them fail. And so that can hurt the smaller banks that aren't viewed the same way, because people might leave those banks in favor of the giant banks. That's what's happened. I mean, obviously not 100%, but there's been a large influx of deposits in Chase and Citibank, and I think Bank of America was like 15 billion in like a few days. It was a lot of money was moving. So that's why it's relevant to regional banks, but I don't know the definition as outlined in the legislation. I guess I could Google it. That, I don't know, that wouldn't be very interesting, but anyway, Dave, that's my take on it. Eminem wants to know where to park $80,000 that they'll need in 18 months, CDs or T-bills. I think both are reasonable. I don't know. I'm trying to think what I would do. I personally would probably go with T-bills, but it would be hard to say. I mean, if I look at, if I go back to all cards, what's the top rate? I think Fidelity's got the best CD rates. So just so you know how this works, if you hover over bank CD rates, you get all these different terms. But if you just click the bank CD rate link here, it takes you to this page where we've got, so far we're tracking 769 CDs. You obviously want to check to make sure the numbers are correct. We do our best to keep it up to date, but we're not perfect. These top are all Fidelity brokered CDs, so they're all over 5%. Here's an 18-month new issue CD, 535. How that will turn out for you, of course, we don't know. I mean, if interest rates spike between now and then, you might be disappointed you locked your money in a 18-month CD, but I can't, no one can predict future interest rates. Certainly I can't. But that's, I think either one, CDs or T-bills, would be a reasonable approach. Santi says, I have a broker. If I have a brokerage account and I sell my stocks the same day the broker goes bankrupt, would the settled cash be protected by SIPC? I mean, I don't know. I don't know. That's the short answer. I don't know why it wouldn't be, assuming it went missing. But I have read some things about that process and how it affects SIPC, but I can't remember what the nuances were. So yeah, sorry. It's a good question. I don't know, by the way. I mean, it's personally not the kind of thing that keeps me up at night, but I guess anything's possible. What would be the odds that like a major broker went belly up on the day I guess it could, if you're an active trader, I guess it could happen. Marcus says, if the 4% rule really works, and historically it really has, based on US data, can I retire this year but use my balance from 12/21? I don't know if that's 12/21/22 or December of 2021, but whatever. Age 66, 60/40 allocation. I'm just trying to think what the issues would be. I don't know why. I guess my first question is, so you say, can I retire this year? My first question would be, why are you using that balance? I don't know why you couldn't. Well, let's back up. If that balance is significantly higher than your balance today, the question then becomes, well, if you take 4% of that higher amount from, I'm just going to assume this is December of 2021. So that would be before the market dropped in 22. You took 4% of that balance. My question to you would be, what percentage would that be of your current balance? Now, if you said to me, well, it'd be 4.1, I would personally say, okay, that's probably not unreasonable. On the other hand, if you said it's 5.2, well, what Bill Bingen's research would tell us is you have, based on history, you're going to run out of money over a 30-year retirement on some limited number of instances looking at historical data. Most of the time, a 5.2% initial spend rate adjusted for inflation, your money would last 30 years. But there are going to be some instances based on the historical data where it won't, or where it didn't. Again, what the future is, your guess is as good as mine. So that poorly worded, rambling answer, what I would say is, if you use a balance from the past, what would that make your initial withdrawal rate based on your current balance? That's really the question. So the question isn't, can I use my balance? Here's where I'm getting. The question isn't, can I use my balance from 2 years ago? The question is, if I come up with a number, maybe I've used a balance from 2 years ago to come up with that number. But if I've come up with a number, however I've done it, what percentage of your portfolio does that represent? And then you do the analysis, again, based on history from that percentage, right? I think that's what I would probably do. And there's a lot of tools you can look at to use to map all this out, from FI Calc to new retirement to on trajectory and many others. But if I understand your question effectively, what it boils down to is you starting out with a percentage higher than 4%. How much higher? I don't know. I mean, Bill Bengen with different asset classes now puts it at about 4.7. But again, that's based on history. The future, the other thing I would say about it too is what I think is really relevant is how much of that money do you absolutely need to survive, and how much of it is just there, nice to have, because maybe you're going to take out 4.5%, but you say, I can live on 3%. The other 1.5% is for travel and hobbies or whatever. The point being, you have flexibility in your spending that you could ratchet down if you needed to, if things turned out worse than maybe the historical record would predict. I hope that made sense. It's 8:21. I think I'm getting tired. I don't know. Maybe it's the flannel shirt. It's hot in here. Okay. So another question, what are your thoughts about investing a small amount of one's portfolio, say 5%, in private market alternatives, such as those offered through a platform like YieldStreet? I don't have any issues at all with people taking, a small percent and doing something different with it. In my case, it was investing in individual stocks. I'm not sure. I mean, the questions I would have with YieldStreet, and I've not dug into the details of it. I'm familiar with the platform, but that's it. Fees, always a big issue. Liquidity, how they value their investments. How can I get my money out? What are the tax ramifications of a YieldStreet investment? Those would be my concerns, or the things I would want answered before I went down that path. Scrooge McDuck wants to know, when tinkering on a portfolio visualizer, have you come across a particular allocation that outperforms in most time frames, even if somewhat complicated, other than the basic 3-fund large cap leaning portfolio? The short answer is no. The more complicated answer is yes, over some periods of time, but not consistently over all periods of time. You can put in, gold, for example, in the right periods of time will do very well. As part of a portfolio, not 100% gold, but as part of a portfolio. You can put in a lot of small cap value, and over the right time period, it will do well. But when you start breaking it down and looking at, say, 10-year period chunks or 20-year period chunks, I think it's pretty difficult to find something that consistently beats sort of a portfolio that, for the most part, just mimics the overall market. You certainly can, but yes, you can drill down and find, interesting portfolios that for some period of time do much better. But nothing that I've been able to find where I said, okay, I'm comfortable with this. I'm going to go with this sort of complicated, unique portfolio for the next 30 years, and I'm pretty comfortable with it. That I've not found. That doesn't mean it doesn't exist. Just means I have not found it. So someone asked, they just have letters for the thing, letters and numbers for their name, but my North Carolina home assessment just doubled. Any recommendations for next step to challenge? Well, I actually challenge our real estate taxes successfully, not where we currently live, our old home. And I did it based on comparables. That's what I used. I forget what the issue was, but our assessment was significantly higher than comparable homes that had sold in the same year as ours did. I don't remember, or maybe I never knew why they assessed it that way. They don't really tell you, at least here in Virginia. But that would be one way, is to look at comparables. And so if you've got a comparable home, so they have formulas they use to adjust all of this. But of course, in a lot of locations, the market has come down, or some. I mean, the real estate market seems crazy to me. It doesn't always seem to make sense. But if you see homes that are comparable to yours selling, at a level, that you think you can use to challenge your assessment, that's what I would look at. But you've got to also keep in mind that assessments are often below a lot of the sale prices. So it depends how they are doing. I don't have a clue how they do it in North Carolina. But that would probably be what I would focus on. There might be other approaches, but that's, the other thing you might do is talk to a realtor and see if they've dealt with this and how they've approached it. Let's see. How much time do we have? We're running out of time. Kit wants to know, hey, Rob, huge fan. Please share your daily routine. How do you manage time, etc.? Well, my daily routine has been a bit upended lately. As I think I've mentioned, I'm helping a family member with some health issues, and that involves some travel. But I would say for most days, I am up, but I don't set an alarm. I am up most days between 5 and 6, but sometimes I sleep until 7, which is delightful. I'll usually open the iPad and just check news and stuff briefly, stumble downstairs to make up a coffee. I weigh myself every morning. I don't know if you needed to know that, but I do. I weighed 184.1 pounds this morning. I will say recently, I've not been nearly as productive first thing in the morning, which is a problem because I find that is the best time to work. Today, I came down here and I had to do some coding, not very complicated coding, but some programming. And then my wife usually wakes up after me, and I make her a cup of coffee, take it up to her. We sit and talk and drink coffee. And then today I left the house, went to a Starbucks and worked for about an hour. Then I went and did yoga, Bikram hot yoga for an hour and a half. It about killed me. Today was rough. And then I went back to Starbucks to finish some things. Then I came home. And then when I was home, it was spending time with the granddaughter, doing some more work down here. I actually took a nap today. Not for very long, but I was tired. That's kind of my day. A lot of days look like that. I do yoga a lot now, probably 5 times a week. Oh, I also worked out this morning before I went to yoga, which involved mainly push-ups and some leg ups. And then after the show is over, which is in 1 minute, I'll probably go upstairs and watch some TV. For like an hour, watch a show. What I've not been doing a lot of is reading. There have been a host of reasons that I hope end this month because I really miss. I'd like to spend an hour or 2 a day reading. And this month I just haven't been able to. I will start cycling too now that the weather is getting warmer, and that takes time because I usually go 20 to 40 miles. So that can take. I'm not a very fast cyclist, so it takes me some time. I spend way too much time playing speed chess. That's the one thing I need to probably get rid of. And it's not, by the way, a matter of being productive. It's that if I'm not going to be productive, I would, and there are plenty of times when I'm not, I'd rather be unproductive in ways other than playing speed chess for the most part. Yeah. So there you go. That's my day. That's my kind of my routine. I don't have a set routine where I do the same thing every single day. I'll have coffee with friends. I meet someone at a coffee shop periodically. I have lunch with former colleagues, probably once every month or every other month. Yeah, that's about it. All right. Well, it's 8:30. I'm actually looking now at the regular chat just to see if I've missed anything interesting. Noreen says, nice of you to bring your wife coffee. Yeah, I've been making her coffee and taking it up, I mean, for as long as I can remember. But yeah, that's just time to chat and what's going on with the day. And, it's old people conversations. How'd you sleep last night? Oh, it wasn't very good. I mean, no, it was terrible. I don't know. Oh, it's pathetic. Well, she's not. I am. It is. It's like sleep at night. I still sleep pretty well. But, when you say, are you feeling your age? I think physically, I feel pretty good. Knock on wood. But where I've noticed it is sleep. And it's not that I don't sleep well, but I don't sleep as well as I used to. I wake up more often now. And it's like, that's like the biggest thing. Sleeping. And that's how I hurt myself. How'd you hurt yourself? Well, I don't know. I was sleeping. I woke up and I was in pain. I don't know what happened. Oh, well. All right, gang. I hope you enjoyed this. Thanks for the 100,000, by the way. I guess the next stop is 1 million. That's probably silly. So I will be back again, Lord willing, and the creek don't rise, 2 weeks from today. And so until then, have a great couple of weeks. And remember, the best thing money can buy is financial